Welcome to this lecture on year-end planning for individuals. My name's Dean Wootten. Now in this first lecture we're going to look at income tax, and in the second part we're going to look at the capital taxes. So just a few ideas for year-end planning, and not rocket science at all, but just a useful reminder of what we should be looking at for clients approaching the end of the 17-18 tax year. So first up, personal allowances. The personal allowance for 17-18 is £11,500, and obviously we've got to use that allowance this year or we simply lose it. Now that could be by paying extra salary, bonuses within the personal allowance, corporation tax deductible, providing it's obviously commensurate with duties, and it's tax-free on the individual. We've got to appreciate that we may well be creating an NIC liability at the £11,500 mark. The national insurance kicks in at £8,164. So we are creating some liability to national insurance, but possibly only ease national insurance, because if the company hasn't utilised the whole of their employer's £3,000 allowance, then we may well not pay the employer's national insurance. But we obviously got to pay attention to that national insurance implication. You could pay somewhere between 5876 and 8164. You are still utilising some of the personal allowance, but at that level you're not paying any national insurance, ease or ERS, but you are crediting your state pension. So somewhere between there, no tax, no ease, no ERS. Over and above the 8164, there will be ease, there possibly might be ERS, depending on whether you've utilised a £3,000 ERS allowance. And do remember, if you're the only person in a company that's triggering a liability to ERS and you're a director, then you will not get that £3,000 allowance. But you may have one or two employees, and at least one of them's paying the ERS or triggering the ERS. Therefore, you will get the £3,000 holiday. So you have got to look at that NIC interaction. And obviously, if you are doing salaries, we've got to be RTI compliant. Instead of doing salary, you might want to consider dividends. Dividends are easier, no national insurance, no payroll, no need to justify them, that they are just paid. There is no CT deduction, but the fact I do have this flexibility and you don't have to do anything for them, you don't have to work for them, then they are safer. Now you could pay £45,000 worth of dividends and only have a tax bill of £2,137. That's an effective rate of 4.75. That's the high rate threshold, 45,000, less the personal allowance, less the 5,000 dividend allowance, times the basic rate of dividends, 7.5, 2137. So a very cheap means of extraction. Approaching the year end, we also need to be aware of the client's overall income. So if it's over 100,000 or likely to be over 100,000, is there any income we could defer until next year? Maybe there's a bonus, or maybe there's a year-end dividend they're thinking of. They're thinking of 31st of March. Maybe we should be able to push it into, say, 7th, 8th of April. So keeping below that 100,000 would have its advantages. We could also divert income to lower taxed spouses. Quite tricky at this late stage, but shares might be able to do that. And when you are transferring assets, make sure it's the assets that are being transferred, not just the income stream. This will be particularly important in 17-18 with the introduction of these new finance charge rules for buy-to-let properties. If we had a basic rate spouse and a high rate spouse, basic rate spouses are not affected by these new finance charge rules for buy-to-lets. So therefore the buy-to-let should really be held in their hands. Now that will be better from that perspective, and obviously it does keep the income low, utilises basic rate. Obviously in some cases the adding back of the interest in 17-18 and onwards, it increases the income of those basic rate spouses. But if they are basic rate and they stay basic rate, even with these new rules, then they really should be owning those properties. If you are moving properties, obviously we've got to get the mortgages in order. There might well be different lending terms. We might have an SDLT charge. You should be able to get around that. But you do have to consider the SDLT implications. Unmarried couples, it's slightly trickier with unmarried couples because when they move assets between them, they are moving at market value for capital gains purposes. So you do have this potential CGT on transfer. Some assets are eligible for gift relief, so shares in unquoted trading companies, furnished holiday lets, so there wouldn't be any tax charge on those. Otherwise, if you are trying to shift assets from one party to another and they're unmarried, then do select assets carefully. Assets standing at low gains, for example, or cash, gilts. So the CGT exposure much reduced if you choose your assets carefully. Utilising the children's personal allowance. Do watch the Parental Settlement rules. So any income above £100 will be taxed on the parent if it is sourced from the parent. There is no restriction, however, on non-parents, such as grandparents. So you could have income diverted from grandparents to grandchildren, and you wouldn't be subject to these parental settlement rules. If there's a discretionary trust around, then these distributions are net of 45%. So a net distribution of 6325 in this tax year does utilise the grandchild's personal allowance. Yes, you'll have tax deducted at source, but it can be reclaimed. And distributions do not have to be cash. You could be settling the school fees for the grandchild. So making sure we don't pass through his tax year without utilising the personal allowance that we could do with, say, children. For some couples, they have the ability to transfer some of their personal allowance up to 10% of their personal allowance. Now, the donee gets the 20% reducer, so that's £230. You can backdate to 15/16. But you only do this if neither spouse is a high-rate taxpayer. So two basic rate spouses, one of them's not utilising their allowance. We should be able to utilise it. But let's say one of them's not, then we could just move 10% of it across to the other half. Child benefits are worth considering. Obviously not for very high earners, but for a lot of people, child benefits is a very real benefit that they do rely on and are reluctant to lose. Now, if your income goes above $50,000, then you do start to lose the child benefit. There is an effective rate of 65% if you have 3 children and your income is above 50k. So you're losing benefit at quite a rapid rate. Ideally, we should be looking to equalise income between spouses that are relying on child benefit. It does seem quite wrong that 2 spouses with income of, say, 50k can have a full-blown claim. However, one spouse with a £60,000 salary has no claim. So it does seem unfair, but that's just the way the rules work. If both spouses are under 50, then they're looking under 50,000. Then they're looking at decent child benefit claims. If one spouse earns nothing and the other earns 60, then you're not looking at any child benefit claim. Obviously, as we're approaching the end of the tax year, we always think about pension contributions. These are treated as reducing income, so it can bring income below the 100,000, and we do get the 60% effective rate of relief. So if we've got a client earning, say, 110, then we really should be telling them 10,000 contribution if I were you, because you're going to get 60% relief on it. Because when you get below the 100, you stop losing your personal allowance. Above 100, then you lose your personal allowance. So we've got this effective rate from 100k all the way through to 123. So double the personal allowance, 100 plus double the personal allowance, because you're losing it for £1 for every £2 over 100. So if I did make a 10,000 contribution and I was earning 110, then you are getting an effective 60% tax rate of relief. Obviously, if we are doing pensions, to utilise this, we must pay them before the 5th of April. Do watch the annual allowance. £40,000 a year is permitted. If you haven't used up your allowances in prior years, you can go forward 3 years' worth. And obviously watch out for clients whose income does go above 150. Obviously for them, there's not a lot of chance of getting them below 100. But for them, we've just got to have an appreciation that you've got a £10,000 annual allowance because your income's over the 150. So we should always be looking to optimise high rate tax relief wherever possible, wherever affordable. It's probably more accurate. Ideally, don't pay pensions in the basic rate band. Obviously, some people do because that's all their income is and they want to make pension contributions. But if we have got clients which are in and out of higher rate taxes, then we should just wait for the years when they are higher rate taxpayers to make these contributions. Gift aid is also an effective means of preserving personal allowances. So if we did have over 100,000, you've fully utilised your pension contributions, then maybe gift aid. Obviously it's not going into your pot, but it does have the same impact. And it's also worth mentioning that if you have got an owner-managed corporate, then company contributions, they are extremely effective. Obviously, if we're an owner-managed corporate and we're only paying ourselves a salary of 11.5, say, then we are restricted as to how much personal contributions we can make. But if we're trading through our own corporate with that £11,500 salary, then the company can make contributions into our pension fund. Now, the company only obviously gets 19% corporation tax relief, providing the pension contributions annual package is reasonable. But it's a tax-free extraction, effectively. So it's well worth doing. You've got to remember, obviously, the £40,000 annual allowance, but that can be supplemented by unused reliefs brought forward. So corporate contributions are an effective means of extracting. Obviously, it doesn't matter so much pay before the end of the year for the corporate, but it does matter for the annual allowance. So if we're trying to utilise, let's say, 3 years ago's annual allowance, and it's about to drop off, then a corporate contribution will start to mop up that annual allowance. Dividend allowance, so 5,000 for 17-18. It is reducing to 2,000 from April 18. So obviously we need to take advantage now. I'm sure all clients are taking advantage, but it's really just trying to get them to focus on. Do make sure, if you can, having a dividend of at least 5,000 this year. And also, I think we should be asking ourselves: have we got clients that could utilise their £5,000 allowances for children? Now, this will be children over the age of 18. Now, if they're over the age of 18, and let's say they're at university, then it would be reasonable for them to have some shares in your trading company, and for you to be routing £5,000 of dividends through those shares so that they can pay for their university accommodation, for example. Now, that's obviously a tax-free for the individual because they don't pay tax on £5,000, and it's better than you paying for your child's university accommodation out of taxed income. Now, you can restructure the share capital so that you restructure it into alphabet shares. Now, if you are doing that, and you'll be doing that so that you could have dividends on the Bs, say, which are not the same as the on the A's, so you can differentiate between, let's say, the parents' dividends and the children's dividends. The parents might want to be taking normal dividends and then just drop £5,000 into the children's B shares once a year. Now, if you're doing that, do make sure you create those shares properly. That would be using a secretarial agent. And do make sure that the shares all go to the parents first. So I've got, let's say, ordinary shares, ordinary A's, ordinary B's, ordinary C's, and I gift the ordinary B's to my son. I gift the ordinary C's to my daughter. And now if I do that, and they're full-blown ordinary shares, etc., then you do have the ability to utilise this 5,000 through those B's, through those C's. Important to recognise that these dividends, they are taxed at 0%, but they are still income. So you've got to add the dividend into income, and in most cases, that's not going to have an impact. So if it was children at university, for example, they're not utilising their personal allowance anyway. So paying them dividends within the 5,000, that's not going to be a problem. Even above the 5,000 is not going to be a problem if they're not utilising the allowance. But it does count towards income. So careful when you're around the £100,000 level. Extra dividends can generate that high charge, i.e. loss of personal allowances. So personal savings allowance, this is fairly new. We should use it wherever possible. It's not a huge amount of money. It's £1,000 for basic rate taxpayers, £500 for high rate taxpayers. Now that is interest. Now, if you had director's loan account in credit, then you could utilise those loan accounts in credit to get the £1,000 out tax-free or the £500 tax-free if you're a high-rate taxpayer. There isn't any savings allowance if you're an additional rate taxpayer. Now, if you are paying interest on director's loan accounts in credit, then do remember that it's tax deductible at source. So you've got to do it via the CT61 procedure. Now, that amount of money is not overly attractive, but for OMBs, owner managed business clients, you can look at the 0% starting band in addition to the personal savings allowance. Now, that's the £5,000 0% rate on interest. Now, that means for some taxpayers, let's say I've got an owner managed corporate, the owner manager could pay themselves £11,500. They could be taking £20,000 worth of dividends, say, so they're a basic rate taxpayer, and they could pay themselves £6,000 of interest on their director's loan account in credit. Now, that would be completely tax-free. If you're a high-rate taxpayer, let's say I'm taking £11,500 salary, £60,000 dividend, say, then I could pay interest on my loan account in credit of up to £5,500, and that would be completely tax-free, even though I'm a high-rate taxpayer. Now, that's quite simply because your salary, which is the only things you count towards the £5,000, is covered by the personal allowance. So you're deemed to not have any income for the purposes of the £5,000 0% starting rate. Now, if you are paying interest, you've got to make sure the rate isn't too high. I would say somewhere between 6 and 8% is perfectly reasonable on a director's loan account in credit. It is unsecured, so therefore 6 to 8% shouldn't create too much tension at all. Now, if you are looking to utilise either the £1,000 or the £500, or in most cases, hopefully, the £5,500 or the £6,000, then you need to make sure the interest is paid before the end of this tax year. Now, for me, paid would obviously be physically leaving the company, the money, into your hands, but you could credit it to your loan account, but do credit the net to your loan account, and do complete the CT61 on a timely basis. I think HMRC would be interested if, let's say, we did credit the loan account with the net, but the CT61 wasn't filed until, I don't know, October. Now, if I'm HMRC, I'm suspicious. I don't think that loan account credit went in March. So therefore, loan account and credit in March, CT61 filed shortly after the end of March, then that is paid. And that interest should be in the 17-18 tax year, and you should be looking to utilise either the personal savings allowance on its own, or if you're an OMB, you're looking to utilise the £5,500 or £6,000 if you've got a salary at that £11,500 mark. So let's look at ISAs now. So always something to consider pre-year end. So we have a very high ISA allowance now, $20,000 per person. Wealthier taxpayers ideally utilise that every year. But I think the one that is not, I wouldn't say more attractive, but it does have added advantages, is the lifetime ISAs. Now, these lifetime ISAs have only been in this year, so they came in from April 17, and they're aimed at people saving for retirement or buying their first home, so they can be used for a deposit for your first home. Now, the attraction for these is the government give you a 25% tax-free bonus on your contributions. Now, the maximum bonus is £1,000 per year. So therefore, if you were to put £4,000 into your LISA by the end of this tax year, then it becomes £5,000 shortly after the tax year, because the government put this bonus in. Now, that's available every year. So next year, if I put £4,000 in, the government will put another £1,000 in. So it's tax-free money, and it's almost rude not to take it. So this 4,000 LISA, I think, should definitely be discussed with clients. There are some restrictions. You can only open it if you're aged between 18 and 40. But I'm looking at this and I'm thinking, well, anyone under the age of 40, if they do have spare money, surely should be looking at a LISA, because you've just got the government giving you this £1,000 bonus. Now, a lot of these people are using LISAs for first-time buyer deposits. That's what essentially they're being used for. But they can be used for pensions. So if you're 30s, in your 30s, already have your first home, then obviously that's out the window. So it's all about pensions. But if they're giving you this 25% bonus, then for that, I think it's okay. Obviously, you're not getting tax relief on the contribution like you would with a pension, but when you hit retirement, you can extract the money from these LISAs completely tax-free. It's also worth considering utilising shares in your trading company to pay a £4,000 dividend to your child over the age of 18, so they can contribute into a LISA. If you're a parent wondering how on earth is your child going to afford to buy a home, and when you look at the problems with buying first homes, it tends to be getting the deposit together. And if you're contemplating that you may well be asked to, or not asked, but you may feel that you want to help with your child's deposit, then thinking early and extracting via your company and then into a LISA from there, that's a very efficient means of extraction. So maybe I'll restructure the shares. My son or daughter has 1 or 2 B shares, say, full-blown ordinary rights. And then once a year, a £4,000 dividend is paid. And that dividend goes into their bank account, and they make a contribution to their LISA. Their LISA balance is then increased to £5,000 with the government bonus. So it can be used in lots of different ways, and that's just one example. But I think they're attractive, especially for people trying to save up for their first home. That 25% bonus is quite attractive. The actual number of products available in the LISAs is much better than it was. There is still only one cash LISA, that's with Skipton, and that's paying virtually no interest at all, about 0.75 I think it is. So not great, but you've got the 25% bonus. There are a lot of equity LISAs now, and you can choose your risk profile. So you can choose a risk profile quite low, say 3, and you should, I hope, to beat the very low Skipton interest rates. But you've got Hargreaves Lansdown these days offering loads of different funds within the LISA. You've got AJ Bell, you've got lots, there's, I think it's One Family, there's loads. If you search LISA, there's a lot come up. So there are choices for equity LISAs, and if you're looking at 5-6 years to hold it, then maybe they should be considered rather than, say, the interest LISAs. EIS, 30% income tax reducer. You only need a 70p return in the pound to break even. You do get CG deferral on any gains that you're putting in or reinvesting effectively. And there is no CGT on the gains on the in the EIS shares themselves. You can set EIS losses against income. Death does wash out any deferred gains, and shares on death should be eligible for 100% BPR. So EIS is always something to consider for clients around the year end. We also have the seed enterprise investment schemes now for startups, 50% tax reducer up to 100,000. It's very much for those startups. So gains used to make investments are 50% exempt up to 50,000, and you can set SEIS losses against income. So very, very similar to EIS. I would probably say more risky because they're startups, but because they're more risky, you do get slightly more attractive tax incentives. VCTs, so VCTs, 30% income tax relief up to 200,000. It's different product, but we really should be looking at it and just seeing if clients fancy it pre-year end. Dividends are tax-free, gains are tax-free, prices usually squeezed on sale. There's not an active market for them. And you cannot carry back VCT subscriptions, not like you can with EIS and SEIS. So not as attractive as the other two, but they're another product to consider for clients. Well, that concludes a run-through of maybe year-end ideas to consider. So not rocket science. I'm sure you've thought of some, all of these. It's just a little health check, really, approaching the year-end. What should we do for clients approaching the end of 17-18? Well, thank you for listening to this lecture. My name is Dean Wootten.